Hello everyone. Today we will start the next theory from capital structure, that is net operating income approach. The net operating income approach is a capital structure that believes the value of the firm is not affected by the change of debt component in the capital structure. It assumes that the benefit that a firm derives by infusion of a debt gated by the simultaneous increase in the required rate of return by the equity shareholders. With an increase in debt, the risk associated with the firm, mainly bankruptcy, also increases, and such a risk perception increases the expectation of capital shareholders. So, capital structure of a company is a mixed ratio of debt and equity in the company's mode of financing. This ratio of debt in the capital structure is also known as financial leverage. Some of companies prefer more of debt and others prefer more of equity. While financing their asset, the ultimate goal of a company is to maximize its market value and its profit. At the end, the question stands in front of the relation between capital structure and the value of the firm. The net operating income approach claims that valuation of a firm is irrelevant to capital structure. In other words, the market value of the firm will be same regardless of the proportion of debt. The reason is that any benefit from the increase of cheaper debt will offset by a higher required rate of return on equity. The weighted average cost of capital and the market value of the firm remain fixed at any level of financial leverage. The market value of firm depends on earning before interest and tax of the weighted average cost of capital. Now, the capital structure theory. In a financial statement, capital structure theory refers to a systematic approach to financing business activity through a combination of equities and liabilities. There are several competing capital structure theories, each of us which explore the relationship between debt financing, equity financing, and the market value of the firm slightly differently. So, the net operating income approach generally it study the change in financial leverage which lead to corresponding change in weighted average cost of capital. So, the net income approach theory, which will study the corporate and the finance of business mainly by two means, that is debt and equity. However, the proportion of each of these could vary from business to business. A company can choose to have a structure which has 50% of each of debt and equity, or more of one and less of another. Capital structure is also referred as a financial leverage. So, net income approach generally study the change in financial leverage which lead to corresponding change in weighted average cost of capital. Also, the value of company. The net income approach suggests that the increase in leverage proportion, the weighted average cost of capital decreases and the value of the firm increases. On the other hand, if there is a decrease in leverage, the WACC increases. So, the net income approach was presented by Dodd, which suggests that the value of the firm can be increased by decreasing the overall cost of capital. There are different theories related to capital structure. These are theories to be understood as relevant theories and irrelevant theories. There are four theories. In that, first one is net income approach, net operating income approach, traditional approach. In that, there is one theory, that is Modigliani approach, Modigliani and Miller approach. So, there are capital structure theory includes the modern approach. Modern approach includes three theories: net income approach, net operating income approach, Modigliani Miller approach, and traditional approach. So there are different theories of capital structures have been propounded by many experts. All theories discuss the impact of decision taken by management of the company about equity mix on the cost of capital and market value of the firm. In this chapter, various theories of capital structure are studied. The main concept behind all the theories capital structure is whether the optimum capital structure and maximum market value of the firm is possible or not, and if it possible, how it can be achieved by the mix of equity and debt. There are mixed opinions among the experts regarding the optimum capital structure. All the viewpoints are discussed after discussing the meaning of capital structure. So there are three main decisions of financial management of any business firm, namely investing decision, financing decision, and dividend decision. After finalizing the investment decision, the implement a project, the next step is to arrange the required capital for the project. Capital structure is a decision relating to arrangement of required capital through long-term instruments, that is debt or equity. The composition of long-term financing in the form of equity, debt, and returning is known as a capital structure. If the short-term sources of funds are also included in the financing decision for short-term requirement of capital, it is known as a financial structure. Thus, the entire liability side of finance sheet represents the financial structure, and in the short-term borrowing are executed from the various long-term as well as short-term means of financing. It is known as a capital structure. So, components of capital structure, that is capital structure, become more complicated as various options are available to raise funds, and each option has its own distinct features. Hence, a firm has to take decision of proportion of equity and debt. Now, net operating income approach. The approach is generally from the net income approach, also famous as traditional approach. Net operating income approach suggests that the change in debt of the firm or change in leverage fails to affect the total value of the firm or a company. As this approach, the WACC and the total value of a company are independent of the capital structure decision or financial leverage of a company. As per this approach, the market value is dependent on the operating income and associated business risk of the firm. Both these factors cannot be impacted by the financial leverage. Financial leverage can only impact the share of income earned by the debt holders and equity holders, but cannot impact the operating income of the firm. Therefore, change in debt to equity ratio cannot make any change in the value of the firm. So, earning per share to profit available per equity share issued by the company after the payment of the third party. So, cost of capital is also one of the concepts from capital structure. Are the equity share, preference share, retained earning, and date of cost of capital consist of cost of equity share capital, cost of preferences share capital, cost of retained earning, and cost of debt. The cost of capital is the rate of return of the company which the company has to pay to various suppliers of the funds to the company. Cost of capital has two aspects: overall cost of capital and weighted average cost of capital. The combined cost of each component of capital without giving any weight to particular source of fund, it's called as the overall cost of capital. And if the combined cost is calculated assigning the weight to respective cost of different sources of funds, is called as a weighted average cost of capital. So, cost of equity share, cost of preference share, cost of retained earning, cost of debt. So, all these components are studied, the relationship between each and every component. So, these components which can shows the relationship between each and every component, so it's called as a weighted average cost of capital. So, net operating theory, the theory was developed by David Roth. It probably realized the shortcoming of NI income approach, and therefore it is modified from NI approach to NOI approach. As per this approach, the market value of the firm is based on the earning available for the funds provided after paying all the other expenses except interest on debt. The profit available for a funds provides for Calculating the market value of the firm is called as a net operating income. This theory is just opposite to NI approach. Approach is relevant to capital structure decision. It means decision of debt equity mix does not affect the WACC and value of the firm. As per NI approach, the capital structure decision is relevant and the degree of financial leverage does not affect the WACC and the market value of the firm. NI approach evaluates the cost of capital and therefore optimal capital structure basis of operating leverage by means of net operating approach. So there are some features or you can say assumption of net operating income approach. The overall capitalization rate remain constant irrespective of degree of leverage. At a given level of EBIT, the value of the firm would be EBIT overall capitalization rate. And then value of equity is the difference between the total firm's value less value of debt. That is value of equity is equal to total value of firm minus value of debt. WACC, that is the weighted average cost of capital, remain constant, and with the increase in debt the cost of equity increase, and increase in debt in the capital structure results in increased risk of shareholders. As a compensation of investing in the highly leveraged company, the shareholder expect higher return resulting in higher cost of equity. In net operating income approach, there are no corporate taxes. Cost of debt remain constant at all level of debt. Overall cost of capital remain constant. Value of firm depends on expected net operating income and overall capitalization rate of the opportunity cost of capital. Net operating income of the firm is not affected by the degree of financial leverage. The operating risk or business risk does not change with the change in debt equity mix. Weighted average cost of capital does not change with the change in financial approach. So it's all about net operating income approach. Thank you.